Well, time now for On the Radar. We're here with Brianne Gardner, Senior Wealth Manager, Raymond James. So Walmart is a stock that you're looking at because of what you're calling a two-speed economy. This is super interesting. Been reading about this this week, but take us through why Walmart is on the radar right now, Brianne.
Yeah, we like Walmart, a stock that we own and continue to hold and see certainly some more upside. It's no longer just a retailer. It's really blending their stores, their e-commerce data, and now AI to make everyday shopping smarter and more convenient for investors and for consumers. So the new partnership with OpenAI does let customers shop by simply chatting with them, which is great, dangerous, but great. It turns product discovery into a conversation and gives Walmart really this new tech edge. So e-commerce keeps gaining speed. I think faster delivery, we're seeing this across the board. Growing marketplace means more shoppers are going to continue to choose online presences like Walmart for both groceries and general merchandise. So the market share strength is clear. 90% of even Americans live within 10 miles of a Walmart. So I think that gives it an unmatched reach. And as you mentioned, talking about this two-shape economy that you had been reading about too, people are calling it the K-shape economy or the K-shape. So what that means is that we're split between a two-speed economy, right? Is that you're seeing where higher income earners are spending the usual, as usually they would, on discretionary purchases. So like travel, premium good, luxury items, etc. And low income earners are cutting back on things like dining out or trading down on purchases to grocery stores. So instead of maybe eating at Whole Foods, they're now shopping at companies like Walmart, which again, why we see that upside in Walmart. So the divide is really visible in what we see, the retail guidance. So value in that luxury or thriving in those mid-tier brands potentially face headwinds. So unless you're kind of in the luxury brand or in that lower brand, even think like Walmart, Dollarama, Target, right? Those are the companies that we see are going to continue to thrive.
Yeah, that K-shape is super interesting because we talk about, luxury brands up, 8% in the month of October, year over year, which is fascinating, given all these conversations that we're having about cost of living, about affordability, and the divide is very clear. And I'm wondering your thoughts as we get into the holiday season too, about what that means for some of these retailers.
Yeah, and we're seeing those luxury brands, the LVMH, the Louis Vuitton, Moet, Hennessy, and Hermes are seeing those sales climb. You mentioned, right, 8% in October compared to last year. So wealthy consumers are not slowing down, even with cracks in the economy. I think the message is clear for us, and what we are seeing, especially for headed into the holiday season, is we might see a change in spending on where people are going to be spending. Right? What are those shops they're going to be spending at? Retailers like potentially, Target or those middle class stores could potentially brace for, I'd say, softer holiday season where you see those luxury names start to climb. So for us, that would be something on how we pivot, especially coming into Black Friday and also Christmas and the holidays. We will see it will be interesting to see where people are spending and those prices that are going to be standing out. So will we see a lot of discounts headed into the year end?
Now, the other part of this too, right? We talk about, credit card delinquencies still, at pre-pandemic levels too. The concerns, take me through some of the concerns in this, in that big divide too, as we again, watch for the next couple of months, but then into next year.
Yeah, certainly. I think, yes, credit card delinquencies are still well above pre-pandemic levels. So people are spending money that they don't have. The debt to GDP and debt to income for Canada is, at higher levels than we would like to see, which is, for sure remains us to be a little bit cautious because, of course, if we do start to see, let's say the budget goes through, potentially reigniting inflation, potentially, people are already talking about when interest interest rates are going to pivot. We still see cuts on the horizon, but by the end of next year, will we see increases again? So there is good debt and bad debt. Good debt, we always say mortgages, lines of credit, bad debt, credit card debt, or anything with higher interest rates that are harder for consumers to pay off, because you're just racking up that interest, right? So for us, many families are feeling the pinch on higher goods and higher costs, whether that's groceries, clothing, everyday spending. And we are seeing some consumers cutting back on anything that is not essential. So, non or discretionary items, whether that is clothing, whether that is travel, thinking about spending more locally. So again, that is something we are taking into consideration, because the number one thing that continues to drive the Canadian economy forward is going to be GDP growth, and 70% of GDP growth comes from us Canadians getting out there and spending.
Right. Certainly, again, an interesting conversation. That was Brianne Gardner, Senior Wealth Manager at Raymond James.